So I think we might see a longer correction. And my guess is my framework I'm using, and I'm using some seasonal analysis, suggests that we go up to 50,000 into March. That works perfectly for the Coinbase IPO. Everything calms down because institutional buyers stop piling into Bitcoin futures. They buy a bit of Coinbase first because they can justify it easily because it's just an equity. And then the next run, I think, takes us to 100,000 into June, by which case there's going to be a lot of profit taking. The point you need to think about is what happens in that 4 years? How much cash do you need? You will take some money off the table and run the rest. I think most of us will do that. I don't think most people, because they now understand what this is. So I think people take some off the table at whatever high price you choose. People will scale out. Institutions will keep buying further up for the reasons we talked about before, market cap reasons, stuff like that. And then I think you're right. A lot of people will just hold a lot more than was held on the last cycle, and a lot more than was held on the cycle behind that. For those reasons. But the potential returns each cycle go down as the market cap gets bigger and bigger, because retail cannot drive. If I sell it to you and there's only one in existence, you can drive up the price. If there's two of you bidding for it, you can drive up the price. But a lot of retail investors are in, the institutions coming in, and then it becomes really hard to go from a $5 trillion asset to $10 trillion. To $20 trillion. So I think the returns go down over time anyway. And I think we've seen that in the cycles. But what is the return from the next cycle peak to the next cycle peak? I don't know, call it 200 to 2 million, who knows? Another 10x. Not many things give you 10x, but it feels a bit awkward and a bit of a forced narrative. We kind of have to explain to people that the price is not the headline price. You don't have to buy one of these. It's basically, we just have to explain that to the average person. But again, don't forget, retail is handing the baton on to institutions here. So retail investors will find it hard, and we all want retail participation, not because it drives up prices, because we truly believe it's the best thing for them to do, to have a chance for their futures to be able to pay off student loans or whatever it may be. So we all passionately believe it has a real place in people's personal portfolios, whoever they are and however little money they've got. But the institutions, will continue to drive that whole thing higher because they understand that price is just a number. It's just a number. We just have to get better as a community. As you know, the thing for me that I've been trying to drive is institutional adoption, speak the language. And I can tell from you who haven't come from finance, asking questions, I'm like, okay, fascinating, right? Because you're thinking as an individual investor. We have to now also talk the language of those individual investors and say, listen, just because it's $1 million doesn't mean you can't buy me. It depends. If it just remains a reserve asset, and when it gets, full price discovery, it goes to this 5 volatility asset and looks like kind of bonds or gold's a bit more volatile, but something of that sort, it will just be another line on the Bloomberg screen. And everybody analyzing what's going to drive the price, do I need to increase my allocation? However, there's the other part of this whole equation that you and I really haven't talked about, is what technology gets built on it. So therefore,
true, yeah.
What could it be its future value? So maybe it always remains this weird hybrid of a call option on technology and a reserve asset at the same time. Maybe it does. I mean, Google's been that really. So, Google is a search engine that makes advertising revenue, but it has a lot of call options. Amazon's done the same. AWS was one of the best call options they ever had. It's probably different. It probably ends up looking more like an equity in terms of how it moves around and the kind of narratives that drive it than a bond that become just a macro variable. Yeah, there's another one that most people aren't aware of yet, and I'll make you an intro to them. Bottle Pay, coming out of the UK.
Oh, I know Bottle Pay.
Yeah, so Bottle Pay, there's a bunch of very famous hedge fund people who are involved in funding that to start, and it's basically, they think it's a superior version to Strike, Jack Mallers' product. And I've seen some of it, and I know the players involved, and these are serious people. Will these get adoption? You never know, right? We've all got a million apps and half of them never got adoption. I used to use Viber and now I use, we used to use Skype and Viber for our free calls and now we all use WhatsApp and FaceTime, right? So you just don't know. But I think bottle pay is the one that I've seen that's interesting. Because if there's two payment systems, Strike and bottle pay, okay, we're now starting to see a trend emerging. And somebody will then build another one. Whoever gets adoption gets the adoption, but it means it's coming. Well, we just don't know what's going to get built on it yet because, to be fair, Bitcoin has been slower to build on its architecture than other platforms. So we don't yet know what the smart contract future is. Because don't forget, if you've already got insurance companies using Bitcoin on their balance sheet, well, why would you not potentially use a different layer of the Bitcoin blockchain for your insurance contracts with complex terms? Lloyd's of London is a very complicated thing, but maybe you can put them all on the blockchain. So I think insurance is one of the clear disruptors. I think gambling probably goes on the blockchain. Again, because we can make complicated bets. Like you and I have got a bet. If you did that,
you've got a bet.
Blockchain, then I know that you can't welch out of it. It becomes really interesting because you can have complexities in smart contracts of bets. If this happens, if it's sunny on Tuesday and so does this, then this is the payout. And that applies to all sorts of contractual terms. So there's a lot of things. There's supply chains as well from corporations. So it's much bigger than just the finance world. It's basically the recorded ownership and trust of everything. Look, I think that's inevitable. With regulation and institutional adoption, it becomes very different. But the community still holds that philosophy true. And that means they will solve this. So they will create private wallets. They will create all sorts of ways to allow them, because it's open source. So you can build anything you want on top of it. So we could create a private payments network between you and I that nobody knows about. So I don't think it's going away. I think it probably just drives innovation. It drives innovation because you can't do it in the banking system. So you become illegal the moment you do it in the banking system once you try and do things that. But with Bitcoin, it's not because it's nowhere. It's very difficult. So that is, I think, going to breed a lot of innovation in the space. I don't think we even have a clue how much innovation is going to come here. So the idea behind negative interest rates is that. Also, it has a nice side effect is the fact that everybody's so in debt. It means governments can fund themselves at zero or negative. In fact, you pay them for the privilege. But that's not that weird. And this is, actually, if you buy gold, you pay a cost. It has a negative carry because you have to pay for storage.